It's April 4th, 2026. While world news is boiling over with escalating tensions in Iran, financial markets are putting on a show that feels completely surreal, even to experienced professionals. If you look at your portfolio today, you're probably staring at the sea of red. The S&P 500 and almost every stock is posting massive losses. But behind this chaos, which is sending many retail investors into a full-blown panic, a situation is building that could historically turn out to be one of the greatest investment opportunities of our generation. What we are seeing right now is completely bipolar market behavior. One day, President Trump posts something about possible negotiations or a deal, and markets shoot up briefly while Brent crude dips just below $95. The next day, the regime in Tehran announces there will be no ceasefire, and boom, oil jumps back above $100 while stock markets tank. This uncertainty is pure poison for the average investor. But for those who know how to act, it is the perfect situation for real wealth creation. Most retail investors will completely see through this moment because they let headlines and short-term fear drive their decisions. So today I want to share my exact plan, what I am doing now and why. I will also walk you through the 3 signals I'm watching closely and who stands to benefit. Let's not waste any time, let's go. Before we get into the details, a quick note. Nothing here is financial advice. This is purely my personal opinion and analysis. So what exactly is the core problem right now? Many people still blindly believe the narrative that this is just about geopolitics. But the real danger lies in the mathematical relationship between oil, inflation and interest rate policy. We need to talk about the Strait of Hormuz. About 20% of the world's daily oil traffic passes through this narrow waterway. Several major trading houses have already rerouted their ships, and drone strikes on Saudi refineries like Ras Tanura have been reported. The market is on the highest alert. If Iran permanently blocks this passage, energy prices will explode globally. And here is where the trap snaps shut. Higher oil prices immediately mean higher production costs and higher transportation costs. This massively fuels inflation, which is already struck well above central bank's 2% target and simply refuses to come down. The Fed is now caught in a brutal trap with no painless way out. On one side, the real economy is already buckling under the weight of high interest rates. The latest GDP data was just revised down to a weak 0.7%. On the other side, the Fed cannot cut rates to support the economy as long as oil prices are whipping inflation higher. The CME FedWatch tool is now pricing in barely any rate cuts before 2027. This is the reason why the Nasdaq and many portfolios have been bleeding heavily since March. We are heading toward a stagflationary scenario that reminds many analysts of the 1970s. But this is exactly where the contrarian opportunity lies. Okay, now let's get to the hard facts, because emotions have no place in investing. When I feel a knot in my stomach, I go for a walk first. And only then I make decisions with a clear head. Let's look at the data going back to 1932. The average bull market in the US has lasted about 4.9 years and delivered returns of around 108%. In contrast, the average bear market, meaning a drop of more than 20%, lasts only about 1.5 years. We are currently in the 4th year of the bull market that began at the end of 2022. Statistically speaking, we are not at the end. We are in a massive correction within an intact uptrend. The problem is that I call our pain bias. Losing $1 hurts about twice as much as gaining $1 feels good. This is why this current dip, driven by the Iran conflict, feels so much worse than it actually is from historical perspective. Look at history. Those who kept their nerve during the crash of 2022 or the financial crisis of 2008 are sitting on a fortune today. Over any 20-year period in history, the S&P 500 has been positive 100% of the time. Statistically, there is simply no way to lose money over 2 decades if you stay broadly invested. Crises are not obstacles, they are the birthplace of real wealth. I personally use phases like this to buy quality stocks at prices I could not have gotten 3 months ago. We can also see that the price momentum of the S&P 500 is now well below its 125-day moving average, which in the context of a long-term intact trend is actually a positive signal. Here is another point that I think is being completely misread right now. Historically, wars have often acted as a catalyst for US stock markets, once the initial uncertainty has passed. When a conflict breaks out, we typically see a sharp dip in the first 30 days. That is the phase where I personally start paying close attention. I hold my nerve and buy in a contrarian way. That is my personal strategy, not financial advice. Statistically, markets tend to recover to pre-conflict levels after about 12 months, and after 18 months we often see new all-time highs. Why is that? Because in times of global chaos, the US is the ultimate safe haven. Where else would you park your capital? In Europe, which is directly dependent on the energy flows from the Middle East? Definitely not. Capital flees into the US dollar and into US companies. On top of that, the US is today the world's largest exporter of petroleum products. While Iran suffers under a blockade, US supply chains remain largely self-sufficient. High oil prices hurt the US economy far less than they hurt the rest of the world. The game is tilted in favor of the US financial system. We can also see that the CNN Fear and Greed Index is sitting below 20 right now. That is extreme fear. Historically, that has almost always been the moment when I personally bought, not sold. My personal view is that despite the current turbulence, we will end 2026 with a clear gain once the first wave of escalation gets priced in. But again, this is my personal assessment, not a guarantee. This is my personal playbook for 2026 and beyond. Not financial advice, just how I myself am setting up. It comes down to the 3 clear pillars. Pillar 1, the foundation. At least 50% of my portfolio sits in a broadly diversified ETF tracking the MSCI World or a similar global index. Historically, it is almost impossible to beat these indices over 20 years through active trading. Pillar 2. Quality stocks, what I call generational stocks. In a crash, I do not buy highly indebted tech dreams with no profits. I buy companies that are cash machines. Companies like Microsoft, Amazon, or in a current environment, commodity giants that directly benefit from rising prices. Pillar 3. A cash reserve. I keep a portion of my capital ready to deploy, sitting aside and waiting for the right moments. My personal belief is, whoever keeps a cool head right now acts in a contrarian way and recognizes the current uncertainty for what it truly is. A time-limited discount on top-quality companies can benefit significantly in the long run. This is not about making quick money overnight. It is about fundamental substance and long-term thinking. If you want to see more videos, just click on one of those 2 videos. See you in the next one. Ciao.